had two sort of points. One, have we built in what could happen in the face of a global recession? Two, I mean, with rates going up somewhere in the vicinity of 200 basis points locally, I'm talking about. I mean, it would be one would expect some sort of growth impact from that as well.
So maybe one way to kind of think about it is that, as Kaushik rightly said, a lot of the indicators that are coming in on the growth, not just in nominal terms, but in real terms, are also probably a tad stronger than what the baseline expectations were implying. So perhaps the RBI is accounting for the impact of the rate hiking cycle, but then growth would have probably been higher without the rate hikes themselves, right? I mean, we would have probably been closer to around 7.5, 7.6% growth. But then in one way, I think the RBI is also not factoring in the downside risks that are emanating from the global monetary policy tightening cycle completely, because, the overall, if you look at the baseline scenarios of most of the major central banks, most of them are not actually forecasting a recession, right? I mean, most of them are saying that inflation will start to slow down, but then growth will have a soft landing, which is exactly what Governor Das also indicated, that the attempt by the RBI is to actually engineer a soft landing in the economy on the growth side. So I think they are penciling in sequential momentum of growth to slow. Now, whether it slows faster or it slows, a little bit slower than what they are penciling in, I think we'll have to see how the consumer behavior plays out to be. The one thing I would add, though, is that certainly on the transmission side, we are seeing a much faster transmission of interest rates in this particular cycle. So that could mean that going into the festive cycle, consumer demand might tend to be a little bit weaker than what would have been the case otherwise, right? So that's just one thing to keep at the back of our mind.
Absolutely. I just close off, although you all through, peppered your comments with your expectations. But Kaushik, so where do we go from here, both in terms of rates, growth and inflation? Just your broad overview for the rest of the fiscal year.
On the growth part, remember that next year, FY24, is the pre-election year. So from some point of view, you would have fiscal support continuing, because that is the year before election. And also MSPs could be increased at a much higher rate. If you remember 2018, we had a big increase in MSP before the 2019 election. And that could be required given the way gas prices have gone up. Maybe everything the government could not give this year. So next year you could have more, giveaway. And, so the fiscal support, in my view, will continue next year as well. And to that extent, growth would be supported to some extent. Now, the question about global impact, normally the sensitivity is about, roughly 50 basis points. So if US, Europe, and China kind of slow down from their baseline estimate by, say, 1 percentage point, whichever point you take, and from there you take down 1%, India would slow down by 50 basis points. So we have already factored that in our model and taken a 6% growth for FY24. But if there is a even deeper slowdown in all these advanced countries, including China, then can India's growth go down to 5.5% to 6% range? It can go down next year. And that's why, I think RBI will go up to a certain point between 6 to 6.5. Beyond that, they'll not want to hike interest rates. And then, let the natural, inflation moderation to happen. On inflation, I think this year we are looking at our own forecast is 6.9, a little higher than RBI's. We'll evaluate based on the different risks that are unfolding, because I think there's still risks on the upside which can come about in the next few months. Next year, as I told you, the steady state is something like 5.5. If you remember FY22, we ended up with 5.5% inflation. And because of the war, we have gone up by 150 basis points. If you even come down in FY24, I don't think it comes down below 5% on an average. We should be at 5.5. So you have to do policy setting thinking 5.5% inflation compared to the target of 4%. Output gap would have closed by next year. So potential growth rate itself has come down to 6%. So you have to keep that in mind. Okay. So with respect to that, I think a policy rate of 6 to 6.5 looks okay. And that's where we should reach eventually. And that's the path I have in my mind.